channel where I discuss investment opportunities and I give you trade ideas as well. So in my last video, I talked about the difference between government bonds and forex trading, and I tried to explain to you what government bond is, and talked about the maturity that is available in government bonds. So in the US, government issued bonds are known as treasuries. In the UK, they are called gilts. I think I mentioned that in my previous video. And every investment incurs risk. Even government bonds, in quotes, as safe as you may say they are, every investment incurs a certain form of risk. Okay, so when you buy government bond, you lend the government an agreed amount of money and for an agreed period of time, and then in return the government will pay you back a set of interest at regular periods, and this set of interest is known as the coupon. So the bonds, comes at the return you get on these bonds comes at a fixed interest rate, sort of. You have this kind of fixed income assets. If you're going for a bond of maybe 1% per month, for instance, because it is fixed, you're not expecting to get 2%, maybe because the government is doing better or the economy is this and that. No, it's fixed. Whatever you're expecting at maybe a given particular time or at a given interval, if it is 6 months, if it is quarterly, whatever you're expecting per quarter, that's what you get. Nothing is changing, it's fixed. And once the bond expires, your original investment amount, called the principal, will be returned to you. On the day you return the principal, that day is called the maturity date. And different bonds come with different maturity. You could buy a bond that is less than a year, or the one that matures in 30 years or more. I was actually reading something, I think yesterday, where they talked about the UK 2047 bond. So this bond, as you're buying it, you're not expecting maturity till 2047. That's 2047. So this is something you're buying, and then you're waiting till that year before you now say, okay, I can take out my principal. And with forex trading, it's not so. If you put $100 in your trading account, you can decide to say, okay, I'm done with this, I want to take my $100, and you will be paid. Especially if your broker is regulated, you will be paid your money. There's nothing like go and come back tomorrow, or we are sorry. You will get your money as at when due, as at the time you place your withdrawal. If it is 24 hours processing time, in 24 hours time you get your money. So I decided not to make lengthy videos. I think I said that earlier in my previous video. So very, very short videos, straight to the point. At least I've been able to infer one thing between government bonds and forex trading. In my next video, I will explain further, and I'll give you more insights and more examples as to why government bonds is different from forex trading. Don't go anywhere. See you next time. Bye.